Okay, so we're going to be talking about tokenization, right? So everyone is talking about stable coins, and there is this new trend that it's coming out very hot about tokenizing from financial assets to real world assets and everything between. And being the stable coins, the rails and the framework that those tokens can be used to connect them to the people and to the fiat rails, right? So basically, we're going to be discussing how stablecoins play a role in tokenization, okay, framing the conversation. And at Zero Hash, we always say that crypto is a technology versus an asset class. And cryptography is the technical basis of tokenization. BlackRock CEO Larry Fink has described tokenization as the next generation for markets and painted a clear vision of moving towards the tokenization of every financial asset. Estimates suggest tokenized real-world assets could be worth $10 trillion by 2030. Brian, something that I have loved about Republic is that you have coined the term cultural assets, right? Can you share more on this?
Sure. So at Republic, we really are just providing access to private markets. Recently, we've been pioneering in this space that we're dubbing cultural assets. So what is that? It's essentially a financial asset that has cultural significance. So in the last year, we have financed a studio house, film house, thereby giving a fan the ability to access and actually finance and be part of or own an actual movie. So isn't that cool? Another example of a cultural asset as we see it is really in the realm of sports. So what better place where you can have a fervent desire for ownership than a fan? Recently at Republic in the last year, we launched Watford. So this is a English football club, and we enabled the Watford fan to invest in the club that they know and love. So cultural assets have a really unique significance in the world of asset ownership and investment, because you have typically you'll have a stronger relationship between the investor and the thing you're investing in. So we're really bullish on it, and there's a lot of interesting things to come. And when we talk about this ownership, we enable the ability to own it via traditional paper equity or via a digital asset, and that's where this concept of tokenization and real-world assets, or RWA, has really come to light.
So Austin from Solana, Mike, we have two Austins. That's why I'm specifically... You have a great vantage point, right? And Austin, what types of real-world assets can we see today in the Solana network?
Yeah, I mean, so the whole point and principle of tokenization here is unnecessary, right, at its core. But so is securitization, so are most of these financial instruments we've created. There's no reason a joint stock corporation has to exist. It's just a very efficient way to do things. And so for tokenization, you really have to think about what makes sense. I know a lot of people are very excited about the BUIDL fund. It's not that exciting. It's a $5 million minimum. It's locked up in the traditional structures. Like, it's a good stepping stones in the right direction, but fundamentally it's giving nothing any investor who had access to that type of capital didn't already have access to, right? And so if what we're doing is basically taking stuff that's locked up under the same rules and structures and access limits that you see in the traditional space and just putting it on the blockchain, like, I guess you can raise a seed round on that, but it's not particularly interesting. The stuff that's more interesting is what folks like Etherfuse are doing on Solana, where they're taking access to Mexican and US treasuries and they're bringing them down from the several $100,000 purchase price when you're talking about Mexican treasuries down to, I think $10 is their minimum fee on something like that. And the only reason they can do that is because there's unit economic savings that happen when you use digital asset ledgers for the basis of this type of stuff, right? If your fundamental reason you're using blockchain is not to reduce the operating costs so you can create better access portals into a product, you're probably doing a fool's errand of tokenization, honestly, because you're not doing it for core reasons that make economic sense, that expand access, expand product market reach, whatever those sort of functions are. And so on Solana, you can see a lot of these different types of real world assets today, but they're generally not large funds taking the existing product and just like copy pasting it onto a blockchain. It's changing access models. The first real world assets you saw in Solana were actually carbon credits, because the carbon credit market is just such a mess where you can get a 25 to 30% discount if you're buying $50,000 versus $20,000. Like, that is a deeply inefficient market. That's a problem that blockchain can really solve and address. When you're dealing with super liquid things where there's already functionally zero fee access, tokenization doesn't really bring you much besides like a checkbox for the innovation report, if we're honest. And so like the stuff that's real is the stuff that like I'm most interested in.
Go for it. When I think, is this working? I don't. It'll work in a second. This is working. So when I think about tokenization, generally speaking, it's cryptography verifiable digital representations of things that are potentially like in physical world, physical infrastructure, and or are representations of money, value, data information, transfer, etc. Now, we just hit our mainnet in May 2024, so a lot of our use cases are fresh, new, and really coming up. We have a couple projects that are growing within our entrepreneur residence programs and our accelerators that are focused on like solar credits. So if you were to run like solar on your house and you want to be able to have a digital cryptographically verifiable representation of that, you could be able to do that on the same network. Now, say like Solana, like a lot of chains, we're high throughput chains. We have cheap gas, we have high TPS, and we have very fast block finality, right? So bringing you the closest thing to a Web 2-like experience to trade and transfer value. That is the main goal of tokenization. What happens though is like you have to think back on why tokenization is better than our current representations, right? It's because people and corporations and centralized entities have the ability to be evil, generally speaking, right? But when you have cryptographic verification of assets and of things and have protocols that set the rules of that, they go from they won't be evil to can't be evil. There are rules baked into that. I think one of the deeper meanings when it comes to tokenization is being able to have the right rules and guidelines and lines in place to be able to let more fair commerce, more fair representation of digital assets or real world assets. By the way, I hate the term real world assets because everything is in the real world, whether it's represented on a computer or the internet or not. So I'm generally very impressed of ways you could take things that have high digital representation and meaning, but then being able to transfer that value chain more efficiently, more quickly, and at a cheaper rate than some centralized and inefficient third-party intermediaries can. And I'm looking forward to new use cases that bring that.
So one, I'm going to pile on and say we need to stop using RWA as a term. I once got a phone call from somebody very senior at the New York Fed who asked me, Austin, why are crypto people suddenly so interested in bank capital? I don't understand. Because for everybody here who hasn't worked in TradFi, RWA is taken. It means risk-weighted assets in Basel III. Stop naming things that are already named.
Yeah.
Two, I think you hit on an important point with tokenization about changing the rules of the system. Fundamentally, blockchains are ledgers. Like, let's not overcomplicate this. In many ways, we could be asking, why are we moving from Excel to an Access database, and hit many of the same questions, actually. And it has to do with the fundamental properties of the ledger. Though, as somebody who's tokenized a lot of things, I would give people some words of caution. One is, I don't think you're ever going to have real assets that are controlled completely by code unless somehow we dissolve nation states in the physical world. Because, like, for instance, I used to run the largest tokenized gold token in the world. And trust me, nothing about a blockchain is stopping a bunch of dudes with machine guns from showing up in a vault and stealing all the gold. You still need all of those concerns. And by the way, nothing is stopping governments from coming and seizing it if they think people are doing criminal things with it. So you need to think deeply when you tokenize things about what systems are we living in, both technologically and legally and physically. I would say back to Austin's distribution point, the other thing you should understand when you're tokenizing something from an access standpoint is often it lets you bring things to jurisdictions that previously couldn't have them or couldn't have them securely. right? And in many ways, if you're from emerging markets with crappy banking systems, poor rule of law, or high inflation, you probably understand the value of this much better than most people, because even the very simplest form of like tokenized cash, and let's be super simplistic, like say somebody takes literal dollar bills and puts them in a vault and tokenizes that as cash, that's probably better than being in, for instance, the banking system in Venezuela.
So let's switch gears to the technology stack on itself, right? So there are multiple chains where you can start and do the tokenization, which by the way, for those who want to abstract themselves from touching the blockchain, we do have a third-party gas station that allows you to basically take care of all the nuances of dealing with crypto. So Brian, from the Republic standpoint, right? You've been tokenizing in multiple chains. How that experience has been so far?
Well, firstly, at Republic, we are very chain agnostic. We want to work with all the chains, so all of you guys, right? We also work within the security token space, so the EIP 1404 to control access, essentially get that sort of approval from SEC that we can indeed be a regulated entity and control and, adhere to OFAC regulations, all that. So with respect to that framework, obviously Ethereum is a little bit, or EVM is a little bit ahead there. So most of our security tokens are initially deployable on EVM networks, right? But we are working with other chains to help define a security token protocol that is essentially the equivalent of 1404. And once these kinds of structures are in place, tested, and working, then that'll give more option. But really, in a nutshell, if you're working with security tokens and the 1404 spec, you really would probably be starting out on an EVM framework. But we do want to diversify and have as many chains in our platform as possible.
Since we have some chains here, let me ask you, what are the must-haves to be able to be a network for tokens?
Yeah, so Solana launched a framework called token extensions in January of this year. This brings all of the type of private permission control you would have on an enterprise private blockchain to public decentralized blockchains. You can put restrictions on how tokens can move and transfer. You can comply with sanctions orders. You can comply with seize and freeze authority. You can have blacklists. You can have allow lists. It gives you all the granular permission structures that you would expect if you were running the system yourself, except these tokens can interoperate with permissionless tokens, DeFi tokens, meme coins, all the type of applications you'd like, because one of our core theses is no one wants the JP Morgan chain and the Bank of America chain and the Citibank chain, right? They might like one thing that all these things are on, but fundamentally the vertical integration and siloing of the banking industry is not good. It just is unsolvable in the traditional model. And that what folks want is they want something that's as free-flowing as anything else in the economy. We talked a little bit about the technology stack that's required for this. I'm a real believer that weak lawyers make weak products. And at the end of the day, the technology is here for companies to do this. There are roles for managed service providers, especially when you're talking about legal and compliance side of things and some technology implementations. But from a technology stack and from actually a legal stack, we have tokenization regimes that can work. We just don't have many companies willing to actually do it. This is why you see the same thing that happened with fintech in the early days, where it was sort of the wild entrepreneurs who were willing to do things like pre-Robinhood days. And then you saw eventually now all the big players actually have their own self-managed stock trading platforms that are kind of Robinhood clones. You're seeing the same thing eventually happen with tokenization. The biggest thing that I tell folks at banks when they're talking about this is if you don't have your legal and compliance team on board, it's probably barely worth doing, because you really need buy-in at the high level to be willing to push the bounds of what is comfortable, because so much of the industry nowadays is outsourcing risk, outsourcing service providers, outsourcing software vendors. And if you try and take that approach to building something on blockchain, it's just not going to pass the checks that your compliance department has, because they're not learning something new. They're not sitting down and actually thinking, how can we actually do this? In the same way that the computerized traders ate the lunch of the paper traders, the same thing is going to happen. The early movers in tokenization are going to get the expansion into emerging markets. And we're not even talking about like Venezuela. We're talking like Estonia, right? Like markets that are like fairly mature and fairly stable, but just are hard to access for companies in the United States. The distribution does it for you when you're building stuff on blockchain, right? The whole idea that you have to go out and acquire customers, the entire relationship changes when you're working on blockchains. The products acquire the customers for you because people are so desperately looking for any type of yield that they can achieve. And, you know, I think that's the real opportunity here. It's not to build the same types of products you've built in the TradFi space and just rebuild them on blockchain. It's to fundamentally rethink what access and what these products could look like when there's functionally zero cost per user.
Yeah, I think like I agree with a lot of what Austin just said. We are also building token extensions within Say from Say Labs. Is going to be proposed to the foundation and then hopefully get passed to be able to give people their own type of journey, whether that's in the permission state, whether it's because when I think of token extensions, really, it's being able to have this like transfer layer where someone can go and grant access to, do I want these activities or things to happen within my ecosystem, within my account, within my customers, right? Like, for example, in a token extension, if you were very, very spiteful, right? And you were like, okay, I want you to be able to, if you invest in this NFT community, I don't want you to access my FTs that I'm launching. You could technically do that on token extension. If you want to say as like a regulator from the United States, you could be able to talk, to be able to interact with the permissionless Say protocol. But if you're a US person, you can't go and trade this on secondary or derivative markets, right? Those are what token extensions really can bring. And that's one area that I think is absolutely a must-have for here. Obviously, for U.S. regulators and for U.S. persons that are interacting with these technologies, you need to be able to have KYC and AML at different points of the process. That's why we partner with a team like CrossMint to do this for like NFTs, and we're working with a lot of like enterprises and brands to build like almost Web 2-like experiences due to the technology they have under the hood too. But those things are must-haves and vital to making this a reality. I also think you need to have more creativity in how you can be able to cryptographically verify different levels of the distribution level, the manufacturer, the sales process, and where and how customers access different portions of these things. And that's where I think some of the projects in our ecosystem are going to be coming around, and you're going to be seeing that progress fairly soon.
I'm going to go the other way and say, I think there's still some very basic things blockchains need to get right to get greater market penetration, especially in developed economies, right? Because right now it's a risk calculus for a lot of users. So I'll ask everybody here a question. Who thinks it's more likely that your bank will fail than you will lose your private keys or send your crypto to the wrong address, right? If you look at loss rates on chain, in the US, it's massively more likely that you will fuck up with your private keys, right? However, in some other jurisdictions, you will see it's massively more likely banks will fail. And where are we seeing adoptions? In the areas where people are sort of consciously taking the risk based on their local system. That doesn't work here, won't work in Europe, won't work in Japan, right? There are many places that are developed. We need to build better and more understandable user tools for normal people, right? I tell everybody tokenization will take off when like my mom can use it. And we're going to need to get to that point as well. So a lot of the very basic tooling is not there yet.
So we're going to be brief on this section, but we have to touch it because this is a stablecoins event and we've only talking about tokens. So gearing to stablecoins Republic would partner to allow you to do on and off ramping. It's clear that stablecoins allows the tokens to be accessed by the people, right? So how our partnership has been working with you guys.
Sorry, I didn't catch you.
How working together with Zero Hash is enabling your customers to be able to access that token.
Sure. So organizations would come to Republic to finance, right? we have a wide swath of companies that come, coffee companies, sports apparel, and we have a lot of Web3 companies. So oftentimes, what happens when you're raising a seed round and you come to Republic and either go through Reg CF crowdfunding or Reg D, Reg S through our broker dealer, the company is going to bring their community, right? That's how we get some of our users. So, your friend or maybe this coffee brand that you love, you want to support it. You want it to see it come into the world. Well, in Web3, the communities are naturally crypto native. So we had a very strong sort of desire from our users to fund their Web3 companies in crypto, and we had our own crypto payment capabilities, but quite frankly, it's a lot of toil, and supporting that is not our main line of business. So partnering with Zero Hash really was a massive enabler. It allowed us to push the toil out and have you guys just handle, all the nastiness, especially with regards to accounting, reconciliation. And really importantly, before, when we were running our own pay with crypto, we open up an omnibus account, payments come in, we don't know paid. We just have a wallet address. But it's quite interesting with Zero Hash, we can actually pair our wallet address with an actual KYC user. And, that's essentially kind of a requirement if you're working in a regulated space. So I would say it's a major enabler, and it allowed our companies which finance with us tighter access with their communities.
Okay, and now for the benefit of the audience, I want you in one sentence to describe what the future of tokenization looks like for you guys. Let's start with you, Austin.
Sorry. Mike. My name is Mike, sir. Actually, it's Mike. I mean, the future of tokenization, I feel like the future of tokenization, for the most part, represents most of the things that are attributed to us, whether it's information, whether it's data, whether it's money that we exchange and extract for value. I think it'd be really huge for use cases in industry and sectors like real estate, when it comes to owning title, being able to share that title, doing on crypto rails and with stablecoins are more faster, more efficient, cheaper. I think it's really huge within healthcare in particular too. If you have like medical devices or you use particular patients that want to be able to pay or donate to specific causes or to specific people, you could be able to do that through stablecoin payments. So you could tokenize those type of relationships and be able to exchange that value more efficiently. There's plenty of things in the financial world with money market funds and with equities and representation of equities that are beneficial there too. I'm going past the sentence, but I think most of the industry verticals and sectors that utilize the internet to exchange value will have this cryptographically verifiable approach that you don't need to have so many inefficient central third-party intermediaries to make those relationships happen.
So if you think of the history of money in various regions, it's a progression from the barter system to physical money to ledger money at varying paces across the world. Tokenization is the first time we have the opportunity for essentially a global omni-ledger where we can trade all goods against all money with all people.
Yeah, I mean, to say the same thing in a slightly different way, it's a 10x reduction in OpEx, and it's a 10x increase in access. And in some ways, that's super boring in the best way possible. That's just like slowly growing the market by 10 to 15% per year for the next 10 years. I don't think we need to look at tokenization as this giant tidal wave that's going to change everything overnight. Neither should we look at AI that way, but but these things, like, this is like, you have to be paying attention to this because 10 to 15% per year compounds really quickly, and suddenly you're going to look like a print newspaper if you're not thinking about it today, right? And that is the wave of tokenization. It's a slow rise that's going to slowly transform all this stuff. I think the biggest, most tangible increase is, I think you probably look 5 years out and most markets are 24/7.
Brian?
Well, I guess I have two answers, really. Answer one would be echoing what these guys said, which is, the future of tokenization is really an extension of the future of blockchain, which is accessibility, availability, operational efficiency, programmability, all that stuff. Really, my second answer is the future is contingent on real market regulation, real market structure coming from the U.S. government, from the SEC, and based on, I think, what happens in the next year with the upcoming election and how post whatever comes out of that, the current bills in Congress, whether they're Fit 21 or what have you, that will be a linchpin, unlocking a floodgate. So
I think I want to add one more point. It will change more when you get people in our political regimes that are probably younger in the United States, where you'll see more of reality. I think today, older people generally are like against tech and are maybe scared of tech, that are congressmen, that are senators, that are in our political spheres. And at one point, when you get younger people who are more used to this and more familiar with it, they will be able to see it and build it at a larger scale and with large companies and touch more people. So that's why I want to point on that.
Okay, so Mike, Austin, and Brian, thank you very much for participating on the panel. It was a great pleasure. Please, a big round of applause for that.